the only central bank still short gold is readying to revalue US Treasury gold reserves. I know there's a lot of skepticism about it. It's happening.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
All right, welcome to Live from the Vault, brought to you by Kinesis Money. And as you can see, I'm back in the vault this week and out of the jungles of Costa Rica. And, Live from the Vault is the show that goes beyond the headlines to uncover the truth about the precious metals industry. And joining us today is Kinesis's very own world-renowned whistleblower and precious metals industry expert, Mr. Andrew Maguire. And this week, we're going to be talking gold and silver, of course. And this is very, very exciting. So let's just cut right into it. Let's go ahead and head over to the UK and talking gold with Andrew Maguire. Hey, Andrew, we've had a lot of subscribers thanking you for keeping a steady hand throughout the first 3 quarters of an extremely, volatility would be the word that has seen gold rising over $970 per ounce and silver over $11 per ounce since our first episode of this year, right here in 2025. And everything you were predicting, both in gold and silver, are bang on. If we had a target and you would hit the bullseye. You've hit the bullseye over and over and on track to be fulfilled, of course, by the end of this year. But following silver and gold hitting the exact levels that you updated us on the charts only 2 weeks ago, we've had a lot of questions on what you expect and into the end of the year here as we move forward. Andrew, over to you.
Hey, Shane, great to have you back in the vault with the shiny stuff, my friend, where you're very, very happy. The jungle's fun, but hey, that shiny stuff's even better. So yes, Shane, it's actually been really we're looking back, this is like, I can't believe it, actually ending the third quarter. It's been a lot of fun though, pulling apart over the time. You remember we've had multiple official attempts to try and talk gold down, tamp it down. And most recently, this is so recently, Citi, even less than 2 months ago, I think it was 7 weeks ago, whatever it was, tried to gaslight the idea to sell gold because it was going to go down hundreds of dollars to as low as 2,600. Do you remember we kind of laughed at the whole concept of it because we knew they were on the other side. And yeah, this is the same bank that, along with JP Morgan, that we captured and published at that exact same time, simultaneously stealthily closing the Fed's 5-year OCC derivative bets. Remember those OCC bets, the officer controller bets? They're only published quarterly. So these guys get to have a bit of fun and do what they want to do in the dark until it's published. But we clocked it. And this really actually all boils down to the fact that the only central bank still short gold is readying to revalue US Treasury gold reserves. I know there's a lot of skepticism about it. It's happening. And as we've been drawing attention to, and we will look at it again shortly, the clues are all there. And our assessment that the LBMA COMEX is no longer fit for purpose is now gathering mainstream attention. And with that in mind, let's look at the current August CME LBMA footprints, which after the Trump tariff tantrum further reveal how an dwindling COMEX open interest, i.e. the chips, no one wants to really trade the chips anymore. It's forcing discipline on the Fed, the only remaining central bank trying to cap the price of gold and versus the dollar. And they need the COMEX to do that. And it is just, there's not enough actors. And even setting aside the Western paper-derived price mismatches versus the Asian-facing physical pricing, it was the Trump tariff tantrum that really exposed the massive structural mismatch between the Western gold market infrastructure and particularly the inefficiency of re-refining London 400-ounce bars into 1 kilo bars that Asia demands. liquidity providers affirm that the remaining COMEX open interest, that's the chips in the casino basically, are insufficient to command enough position concentration to actually meaningfully enable the COMEX-centric paper gold price management to continue. Now, the Fed's price suppression attempts have become so obvious that anticipated intraday, intra-month, COMEX-centric official bid-pulling attempts are capitalized on by the competing global central bank, sovereign, and institutional buyers. Now, these arbitrable physical offtakes are making it increasingly difficult for the Fed to short cover leased bullion borrowings without digging a deeper hole. Into the end of the month, the Bank of International Settlements squaring, the OCC bets, were once again forced to be squared at an all-time higher priced stairstep. And with physical market liquidity now setting the global gold price, the Fed will have to fold its short derivative hand and as quickly as possible get on board the upcoming gold revaluation process. Feedback from every single physical liquidity provider's telegraph that the Fed is anticipated to follow the BIS to also become Basel III NSFR compliant. And remember where the BIS short covered and what happened. And now the Fed is at the position where it's got to short cover. And it's going to have to follow what the BIS did. And then figuring that most likely that the December contract, this is spot here, but this contract, which just launched, which was the December contract, and this reflects that COMEX liquidity, is very likely going to have to move in. It'll move into first notice on the 27th of November, and delivery commences on the 28th of November. So this contract doesn't expire until November. So that'll be right around this point here. Well, we suspect that the price is going to be much more reflective of our spot 4,500 target. Cutting through the last 3 weeks of the thinnest European, this was the European holiday here, that liquidity was extremely thin. This tariff tantrum right here was the point that actually exposed the need to quickly address the LBMA CME cartel's paper to physical disconnect. And liquidity providers report the largest exit of LBMA CME hedging flows, ditching these high counterparty risk unallocated contracts for fully allocated physical gold. And that's what we're seeing. Now, the drain of leveraged unallocated LBMA gold into fully paid up physical gold vaults outside the cartel's ring fence will ultimately force the Fed-run cartel to embrace full Basel III compliance or become irrelevant as a gold trading hub. And what we mean by Basel III compliance, they will have to have the physical that backs up these positions. Drilling down, the footprints are revealed one by one. And as we assessed in our last episode, following the largest technically non-delivery month, just a futures month that really wasn't designed to be a delivery month, the August gold loadout, it was the largest in history. And we expected that any remaining undelivered paper warrants would be forced into delivery by first notice on the 28th of August, which was the last day to contractually deliver or fold your position. And as we've often remarked, in physically settled markets, gold being called for delivery is settled at worst T+1 and obvious, and in many of the futures markets, the physical markets, T+0, but T+1, meaning 1 day to physically deliver a fully paid up bullion bar. So that should be the worst case scenario because that is Basel III compliance. Now, a quick delivery enables the seller of those bars to exit their storage costs, hedging costs, insurance costs, all that kind of stuff. So when they drag delivery out into a T+30 day delivery protocol, clearly it telegraphs the COMEX gold was never real in the first place. It was just a paper shuffle of warrants. And by delaying delivery, the object was to try and square these paper warrants at a cheaper price. So with that in mind, let's start looking at this last 727 foot dragged. I'll call them foot drag. These were last second deliveries. That's 2.26 tons of August deliveries were finally forced to be squared last Thursday, the 28th, which was the last contractual delivery day before being called into a force majeure default. Now, these sort of delivery days had historically been able to rig lower prices so they could be cash settle these price suppression bets. However, following last month's record delivery, which the paper settling of these last Fed-centric August warrants clearly didn't go to plan for them. So again, looking at the spot contract here, into the end of last month, this is where, we mentioned it a minute ago, this is where they were forced to square the BIS OCC bets. And again, at an all-time higher priced stair-step. And this is we froze and captured the action long before the rally really blew up. But essentially, we were looking at the expiring contract. And while about 300 lots of the August open interest was settled at a $5.50 premium to spot, at the 33.97.85 AM fix, the remaining 320 lots had to be benchmarked at the higher 34.07.65 PM fix. It was commanding a very large $13.20 surcharge. But by the pit close, as evidenced right here, the basis trade had expanded to an extraordinary $27.80, really exposing the so-called COMEX quote-unquote hedges as being called for physically delivery were grossly mispriced. And while we saw that then drop down to about $13, still a premium over spot. But this was extraordinary. And again, before the actual breakout, look at where the gold speculators were. And this lack of sufficient CTA open interest to control the price was evident even before the breakout rally. And later data, as of we're recording this on the 3rd, so this is yesterday's data. And so what's particularly interesting is here, you can see that the open interest is really very, very much contained at that price, or even after the rally, that is. And this clearly evidencing the shortfall of eligible, registered, and ounces, total contract ounces available. And while it's helpful to shed some immediate speculative froth, which always jumps on or coattails a physically move higher, given the strong physical market is securing higher dip buying stair steps, which we've been tracking for many, many, many months, and note this was the breakout point, there's plenty of upside room for specs to add longs. And we're recording this after London's cleared. And it's still, gold just happens to still be making fresh highs. This is spot. Also, just ahead of the breakout, the once bearish City also estimated that CTAs will have to close the EFP gap into September. Post that breakout, it's clear they weren't pushing this narrative very well, clearly. Also, slumbering volatility into heightening geopolitical and trade war escalations telegraphed that gold was coiling for a strong upleg, followed by the breakout. Shane, to get some more subscriber questions and update what we did assess into our last episode, it's clear that the tariff flip-flop ejected a critical mass of asymmetrically imbalanced COMEX hedging flows. In other words, open interest, the chips that float around, they weren't one-to-one, and they got caught out. And they got caught out into Basel III compliant physical exchanges taking this, demanding this bullion. Also, with the US dollar redeemability into gold completely usurped by China's yuan, one-to-one Basel III global convertibility into gold, and the COMEX diluted prices being targeted through its EFP backdoor Achilles heel, accompanying dollar-based paper gold suppression tool, it finally blew up. We looked at it last time, coming dangerously close to blowing up the interconnected $2 quadrillion derivative markets. Now, the SGEI, the international facing, Western facing T+0 vaulting hubs, are sufficiently liquid to accommodate as much one-to-one physical gold hedging business as is needed, uncovering a series of central bank sovereign and institutional sized gold revaluation footprints. Now, there's other bullish drivers that we've been monitoring, and they're also gaining stronger legs following this tariff tantrum. One initiative we've been closely following, and we have reliable feedback on this, that more Chinese pension funds are being mandated to increase their original 1% of their $2 trillion of assets into gold by the end of 2025. Now, they're definitely, that feedback is very reliable. And at the inception of the mandate, gold was trading at about $2,700, equating to about 8 million ounces at the time. That was about 250 tons of a 3,000 ton supply. Since this directive, gold's risen by close to $900 an ounce at 3,500. Now, while this timeline has yet to be revealed, now given the current escalating BRICS trade war leading into military escalations, an additional 1,000 tons, or 1/3 of all global supply, could be demanded by the end of 2026. This feedback has been rock solid reliable, and we expect this to be announced at some point. Also, India's market regulator is considering allowing the country's 177 billion pension system to also buy gold ETFs, a move that could drain an additional 17 tons of new demand, just simply a 1% allocation. Now, this follows the Bank of India switching gears, converting US treasuries into gold directly after the BIS had recategorized FX gold as a first-year high-quality liquid asset on the 1st of January 2023, and is representative of what is also empirically evident across the entire BRICS sphere. Also, sovereign borrowers swapping out of dollar debt into lower Chinese and Swiss interest rates. Asian and Middle Eastern investors are avoiding exposure to the US. Also, it's filtered through to the Financial Times through Goldman's desk, picking up on some unreported central bank gold purchases. Our liquidity providers have been reporting, they've been reporting this since Russia's assets were frozen in February 2022. I think a lot of people knew that this was happening, but I think what's interesting is that obviously we knew that physical gold buying had significantly accelerated when the Bank of Internationals squared all their remaining 500 tons of gold swaps. If you remember, that was on the 1st of November 2022. And that was just before the BIS revalued gold as a first-year high-quality liquid asset on the 1st of January 2023. So for reference, net of paper market dilution, when including direct doré bar imports that seemingly disappear into the 42 district Chinese customs districts, which feed into a 678 loco customs matrix. And we've talked about this before. So much is lost through this system. And we figure this is likely military gold that doesn't get reported. Then if we just base that purely on real global supply demand fundamentals, these same liquidity providers now estimate real unreported central bank monetary gold demand not captured even in Goldman's assessment, is closer to 42,000 tons. This is not yet priced in, but it still marries with our end of year $4,500 target. Now, these swaps of US treasuries for gold cannot be, they're just, obviously the White House knows what's going on and they are following it. And so obviously after the bullish for gold, India, China, Russian SCO summit, which is only just finished over the weekend, this will have severely ruffled the White House's feathers, driving another round of fresh safe haven gold and critical mineral silver demand at the expense of the dollar. In fact, directly pushing back against those pushback, the White House pushbacks. Now, we're going to update more on these extremely bullish developments as they progress. But as the global central bank sovereign institutional de-dollarisation, US Treasury to gold conversion process escalates, it's only a matter of time before the long bond yield rises above 5%, which is deemed as the inflection point that would likely trigger yield curve control, flooding the market with cheap money, which will be hedged with global central bank gold buying. With the US lagging global central bank gold buying, and with only 8,100 odd tons of empirically rehypothecated US Treasury holdings, everything points to a cash-settled forced gold revaluation. With the LBMA, CME now becoming price takers, buying back leased gold reserves will have to be conducted at market. Conservatively, this reaffirms our minimum target of 4,500 by the end of the year. So while not Basel III compliant yet, the structural shift in central bank demand is even more pronounced in the silver market, which is facing a forecasted supply deficit of over 200 million ounces, and that is just the forecasted one, and that leads into a fifth consecutive year of deficits.
All right, Andrew. And on behalf of all the silver stackers from the Live from the Vault community, can you update us on what you're seeing right now? It's been a big week for silver and what you're expecting moving forward with silver.
Yep, it's the breakout we were waiting for. Let's look at the fundamental reason, though, driving this 14-year technical upside silver breakout. And while lagging gold, foreign exchange silver came into the SGE crosshairs directly after the Bank of International Settlements forced FX spot gold to become deliverable. Now, following gold having been revalued as a first-tier high-quality liquid asset on the 1st of January 2023, China, Russia, and BRICS nations began stocking up physical silver for military, AI, and green energy applications, military being a big component of that. However, now that the US has recategorized silver as a critical mineral, what it's done is ignited a race by the US to also stockpile silver, severely limiting the sales of US silver, in turn incentivizing global sellers to hold out for yet undetermined but significantly higher physically determined prices. Shane, here's the monthly target you referred to that we circled in our last episode, which was right here, and the price was way back here. And the end of the month, this is a monthly bar, the end of the month exactly fulfilled the August target. Now, while we expect $52, 53 in fact, or very close to 53, to be secured as the next highest stair step to rally from, along the way, the next immediate target is 44,275. Now, this is a futures chart where we expect a fight here, but very large commercial short stops sit above this pivot. This is where a huge amount of shorts were added, and not all of them have been covered on anywhere close to getting covered on this rally. So you're going to see some resistance and you're going to see a fight, but once it's through, then really it's blue sky. And guess what? Beijing knows exactly where these stops are, here and here. following Trump's unhelpful confrontational comments today, this is the Wednesday the 3rd, Russia, India and China are targeting both gold and paper silver for conversion into physical. This fresh retail demand has not yet translated to the retail market, but it will, further tightening up the 5th consecutive 200 million ounce per annum supply shortfall, providing yet another catalyst to easily drive spot silver through all-time highs. With the US now competing to secure tight for supply physical silver, it's going to unsettle the SGE's stealthy 5-year privileged physical concentration position. Now the gloves have come off, and over the last 5 years, the SGE has successfully utilized control of its global position concentration, employing SGE physical to unallocated spot hedging mechanisms, which were structured to enable them to arbitrage the difference while at the same time containing the silver price, as it strategically was flowed into Beijing vaults. Guess where it was coming from? Or out of the West. So geopolitics, trade wars, and a direct frontal attack on competing BRICS nations declared Beijing no longer needs to be stealthy buyers. And with the CME LBMA open interest migrating out of Beijing's unallocated playpen, so they don't need to play this game, they have enough silver, the race to accumulate silver, along with all critical mineral assets, is underway, catching the US severely on the back foot. The US has come out of the gate with almost no silver reserves, which will mean they will heavily sanction or ban US silver exports, almost certainly. However, the Fed has accrued a very large naked short unallocated Office of the Comptroller listed FX silver position. It's the only place it shows up, which will now come into Russia and Beijing's crosshairs because they know about it too. So they know that that has to be short covered because there is no silver to back those positions up. And technically, FX silver should be deliverable. Now, the White House mandate to buy silver will drive an inflection point, forcing the Fed to buy back these unallocated bets into higher and higher prices. So drilling down, note the massive end of session margin call, where we had a $1.07 EFP basis spread required to short cover the asymmetric imbalanced COMEX-centric December futures, so-called hedges, versus the spot long legs being locked in and called for delivery. Now, footprints indicate this was commercial short covering, which drove spot silver into these 14-year September 2011 highs. Worse, into yesterday's silver short squeeze, into the margin calls, captured here, the EFP basis trade short squeeze had expanded to as high as $1.24 at the open. And given all the major bullion banks are long silver for their own book, there was little doubt these short capitulations were Fed-related OCC bets being bought back. This jives with evidence that the 5-year Fed-held OCC derivative bets against both spot gold and silver had been short covered during the first quarter of 2025. So as expected, December silver futures deliveries have commenced in very large size following first notice. There was 7,702 lots, which was 1,198 tons. They were delivered with another 584 lots yesterday. And there's still about 400 tons left to deliver. So really, in summary, into dwindling overall COMEX open interest, the CME LBMA market makers in both gold and silver are increasingly becoming price takers. To those looking at analyzing the house-generated COT reports, which I know a lot of traders do, the fact that these reports fail to indicate the degree of COMEX to FX spot imbalances, i.e., which lots are hedged or not hedged, these reports are increasingly less relevant. As the whole LBMA COMEX price setting mechanism is irrelevant, and they're being aggressively targeted. What gold is doing is flagging a risk about US debt that other assets simply are not. And with that in mind, there's never been a better time to opt out of the debt-riddled fiat system by simply swapping your debasing dollars, euros, pounds, yen, whatever, for physical gold and silver.
All right, that wraps up another episode of Live from the Vault, brought to you by Kinesis Money. And a big thank you to Andrew Maguire for sharing his deep market knowledge and his accurate market knowledge. And to you also for tuning in and being part of this growing global community. So if you're new here, make sure that you subscribe. You can do that right now. And if you tap on that bell, we'll send you the information in real time as it goes live all throughout different platforms. So if you've been with us for a while, help us keep spreading the word about Live from the Vault by giving us a like right now. That really helps. And share this information and share this episode with someone who really needs to hear it. So get your questions into Andrew Maguire. And to do that, all you got to do is check out in the description below. Click on the button. You can record your question in your own voice. And you never know, you may well be selected for next week's episode of Live from the Vault. And with that, we'll be back next week with more truth that you just won't find on the mainstream media. And until then, remember, buy physical, make sure it's backed 1-to-1, and we'll see you next week. Bye for now.